Bob, your turn. Trade and financial services.
Hi. Well, I'll get to an agenda. I'll tell you what the ending is, because I'm probably going to ramble all over the place. So let's start with the end. The agenda is the United States feasibly can, number one, honor its Uruguay round commitments circa 1995 under the Agreement on Agriculture. Most of the U.S. subsidies that are at issue involve food commodities. The one I think that would have the biggest impact on global development is cotton. The United States has lost a WTO claim regarding cotton to Brazil already. Our obligations are clear. We are in breach of our trade agreements. It definitely hurts some of the poorest countries in the world, and we should honor our commitments. At the end of the George W. Bush administration, the Secretary of Agriculture, Mike Johans, and a bipartisan coalition in the Congress were unable to achieve a trade deal that would honor those commitments. And this is the crux of why the Doha round has failed. So that's number one. Number two, there are a number of select tariffs that actually work to preserve development. And the United States can be very careful about noticing what those tariffs on the part of other countries are and doing no harm to them. If I have time, I'll give you an example, but it's the example is the tobacco tariffs in Vietnam, which we are presently negotiating. The United States is presently asking Vietnam to reduce its tobacco tariffs from 100% to zero. And that has profound public health implications. And the third item on the agenda is for the United States to do no harm to what I would call regulations that promote development, pro-development regulations. And the good news here is that the United States is already taking that position for strange and interesting reasons, and we are at risk of being pushed off that position. So all we have to do is persuade our trade negotiators in the Obama administration to hold the line. So those are my 3 points. But if I could take about 8 minutes, what I'd like to do before returning to that is help you remember 3 stories from 3 continents. And you're the development experts, right? So we all remember history differently and subjectively, so you can correct my faulty memory. So I want to do North America, South Africa, and South America in 8 minutes. See if I can do this. You all remember what it was like in 1993, 1994 when NAFTA was being drafted. And right on the heels of it, the World Trade Organization. Those were heady days for trade lawyers and policy analysts. The vision of the Bush 1 administration and the Clinton administration was that the greatest gift the United States could give to the developing world would be to unilaterally reduce our tariffs, not to zero, but to really low levels in the range of 7 or 8%, which is where they still are. It's quite a gift, right? Wasn't really bargained for much. We just did it. American business was happy to reduce tariff on manufactured goods. I would add at the expense of American workers, because the new supply chain management schemes of global commerce allowed companies to source anywhere and take advantage of wage competition all over the world. So as far as manufactured goods go, the United States' gift to the developing world was to reduce tariffs, except, of course, for U.S. producers that couldn't move around, that is to say, farmers. There, the issue wasn't tariffs, it was subsidies, and by God, we clung to those subsidies, and even though we don't need them at this moment in market history, we're still clinging to them, and that's a big deal for the developing world. Because if you want to invest long term, you know that if the price equation ever changes and food prices start to go down again, those subsidies will kick in and the United States will reinitiate its automatic advantage in global food commerce. So, back to 1994-95, the assumption was that the benefits of this unilateral reduction in tariffs would be NAFTA-led, and it would lead to an economic integration of North America. We would be the United States of North America, economically speaking, Canada, the United States, and Mexico. And before we got to home plate on that one, China happened. And Mexico got lots of jobs and then lost most of them to China. So you've read the papers, you know how the story goes. Mexico's rather disappointed. And the United States' expectations about how the United States economy would benefit from North American economic integration didn't work out quite that way. So now China is sitting on huge reserves based on the decades-long trade deficits of the United States with lots of collateral casualties, including Mexico. Not quite what we envisioned. So did trade policy make a difference? A huge one. Did it work out the way we expected to? Not even close. Okay, so put that story on the side. Think about what's happened in South Africa. So after the revolution, the ANC takes power. There is major constitutional reform premised on racial and economic equity in South Africa. South Africa's government policy toward globalization was pretty much modeled after the so-called Washington Consensus. The United States was South Africa's model. And in many respects, it succeeded. The Johannesburg stock market is transparent, efficient, probably arguably the best stock market in the world in terms of the way it operates. They're developing a close partnership with the Chicago Mercantile Exchange for commodity trading. They're going great guns. They're world players. They're the dominant economic force in Africa, certainly in sub-Saharan Africa, and they're seeing themselves as rivaling other emerging powers, including India. But as you saw from the riots that occurred this year in the mining country, the constitutional revolution really didn't work out in any kind of significant economic change. Yes, there's now a meritocracy in South Africa. Yes, there are many, many college and university educated African leaders in South African business and in the government and in lots of places, but demographically there's been almost no change at all. And now the ANC is on the verge of really losing its credibility and having to face, for the first time, real discipline at the polls because there's about to be a backlash against their leadership. That's pretty interesting. Third story. I was caused to think about Brazil because of my friends in South Africa. And it came out of a conversation I had with consultants who were working for COSATU, the Confederation of South African Trade Unions. And they said to me, what they're really aiming for now in their disgust with the ANC is to convince the government that South Africa should have its Lula moment. What does that mean, their Lula moment? Well, they want to do what they want to roll back time if they could and do what Brazil has been doing since South Africa's constitutional revolution. So it's like a template for bottom-up development. You start with agriculture and commodities, but you build on it. You get synergies between agriculture, commodity extraction, minerals, and petrochemicals. You move into finance, and you make it indigenous. You don't import the capital, you build your banks there. You move into processing your agricultural products, so you don't just do sugar, you do sugar and ethanol, and you don't just do oil, but you refine it yourself. And now they're doing things like building airplanes, and they've become the banking powerhouse in South America. So from the bottom up, building that way, Brazil has not abandoned the global enterprise or the WTO. They participated, but they haven't gotten it out of balance with regional economic development. Their focus has been on South-South development as much as it has been global development. So they've seen themselves as stabilized by Mercosur and the economic coalition in South America, and they've always avoided getting too close to the United States and too close to Europe. Arm's length, that's fine. We can benefit from those transactions, but you get too close, every time the United States sneezes, we catch pneumonia. And finally, and importantly, Brazil has avoided international investment agreements. They've negotiated about as many as we have, but they've only signed 3 or 4 of them. And so they've also kept more than arm's length from agreements that would give foreign investors, including banks and stockholders and companies, from having greater rights than domestic investors to enforce their economic interests. So those are my 3 stories, and the point is simply this. Even though all these countries are playing in the same forums in terms of trade policy, the results are really different. And South Africa now is wishing they really hadn't followed the U.S. model quite so closely and wishing instead they'd paid more attention to Brazil. And now they want to play catch-up using Brazil as their model. So from these, let me just return to my quick agenda. Honor our Uruguay round commitments in terms of agricultural commodities. Cotton's important because it's not part of the same food price boom, and African countries would definitely benefit if we honored our commitments in that respect. We have lost the claim, after all. With respect to focusing on tariffs that really matter in unique circumstances, I wanted to use the Vietnam tobacco example just because when Japan and Thailand and Taiwan and Korea liberalized their tobacco trade, what happened? They were no longer protecting their old domestic monopolies, and so the Japan Tobacco, British American Tobacco, Philip Morris International entered their markets, and you got what you would expect from a trade agreement: competition. Competition driven by lower prices and aggressive advertising and sophisticated marketing, and guess what happened? Smoking rates went up and averaged 10% in each country. If that happens in Vietnam, the smoking rate, which is average, is based upon men smoking at the rate of 50% and women smoking at the rate of less than 1%. So you could easily predict in the next 10 years there will now be roughly 25% of the women in Vietnam smoking. And the impact in terms of death and the cost of health care in Vietnam will be tremendous. At the same time, they'll be losing tariff revenues, and they'll have a more efficient tobacco market at a significant development penalty, because now the country will have the weight of that health care on its back. Now, finally, and I can conclude by talking about the so-called pro-development regulations. So, very quickly, what does pro-development mean? It means it involves a sector that is central to a country's economic development, and that sector will vary country to country. It could be mining, it could be infrastructure for transportation or ports or airports, if you're a tourism economy. It could be natural resources, fisheries or forests, and almost always it's going to be about financial services. So what's a pro-development regulation? Well, by nature, it's a regulation that is not discriminatory, because that's pure protectionism. We're talking about a regulation that is designed to actually change the way the economy would otherwise work, to bend history in terms of the way the economy would work. So, for example, in South Africa, the black empowerment laws, which are based in the Constitution and implemented through statute, are designed to make sure there's affirmative action throughout private companies and throughout government. So it bends history to make sure that the government and the companies in that country are inclusive. South Africa decided to quit entering into foreign direct investment agreements when they were on the verge of losing a claim brought by Italian investors who didn't want to have to bring in to their boards of directors and their stockholder club black South Africans who would effectively implement those legal obligations. That's when South Africa said, whoa, this is against our Constitution. Another example of a pro-development regulation would be antitrust law. It's a law that's designed to keep companies from becoming too big to fail and too big to have market power, that is, the power to actually influence prices in the overall economy. That's a restraint on trade. I mean, that is a distortion of trade if you stack up any of those policies against any number of trade rules, especially those that relate to investment and services. So the last example I'll conclude with is our conversation about commodity trade. So let me give you an example of a new commodity market and an example of a trade rule that would conflict with it, and why the United States should make sure that this conflict doesn't really come to happen. Ethiopia has a new commodity market that they've created because they want to get away from the huge impact that speculative trading by these investment banks has on the price of food in their country. They want to go back to the way it was. Can they really roll back time so that instead of 80% of the derivative traders being investment bankers and only 20% being food producers and food sellers, it goes back to where it was circa maybe late 90s. So the 80% of the people in the market would be actually the food traders, and only 20% would be the so-called speculative traders. The only way to do that is, frankly, to require those who buy a derivative to actually take possession of the asset. to actually hold the wheat. Why would they do that? Because they're the ones who want to make bread with it. And it would essentially have the effect of screening out the investment bankers from that market. If they could do that, they could insulate themselves from the whiplash of speculative investment from investors like my retirement plan, Vanguard. When I go on the web, the first thing they want to sell me is an exchange-traded fund, and guess what it invests in? Food commodities. Why? Not because they're banking on a market timing profit because of the rise in food prices, but because they want to diversify the food market against their other assets, the stock assets, the real estate assets, the currency assets. They're using it purely for purposes of, if you will, diversification. And that's how they're selling it to me, but it has a huge adverse effect on these markets. So what's wrong with Ethiopia's attempt to opt out and say, no, we don't want to be part of your system? First of all, there's a WTO rule that says that if you sign up to the WTO financial services rules, you promise to allow any financial service that's legally authorized by any other WTO member country. So if that includes speculative derivative trading by investment banks, you have to allow it. There's another rule that says, in terms of market access, you can't impose any quantitative limit on service suppliers. Well, if you exclude the dominant players from the market altogether, that's a zero quota on bankers. Flat-out violation of WTO rules. And there's a new rule being proposed by a number of countries that says, across any sector in which you have trade commitments and services, your regulations must be no more trade restrictive than necessary to ensure the quality of the service. And the way that rule works out is, basically, if you have anything that's less restrictive than the measure you're adopting, like Ethiopia's new market that says no bankers, please, that measure has to be the least trade restrictive compared to any other available alternative. Well, there's nothing more trade restrictive than a ban or an exclusion from a market. And that's the rule where the United States government, thank God, finally stood up and said, no, that's enough. Even for us, the capital of capitalism, we have too many domestic laws that are not the least trade restrictive. In fact, we're actually a democracy, and most of our laws are not the least restrictive, they're the most, and they're not the most restrictive, they're somewhere in between. And that's really what's at stake now in terms of current global trade negotiations. Will services such as regulation of commodities be held to this new standard of trade liberalization? It's not about tariffs anymore.
Thank you. I almost feel like